Did you know that AI-driven investment tools can analyze market trends and patterns in seconds, something that would take a human analyst hours or even days? AI-driven investment tools are on the rise, and it's no surprise why. They are able to process vast amounts of data in mere seconds, giving investors a competitive edge in the market. But with this rise in popularity comes a natural skepticism. Can we really trust these tools to make smart investment decisions? There are many reasons why investors are flocking to AI-driven investment tools. For one, they are able to operate 24/7 without fatigue, allowing for constant monitoring of the market. They are also able to analyze data from various sources, including news articles, social media, and financial reports, to give a more comprehensive view of the market. But despite these benefits, there's still a sense of unease among investors. Can we really rely on AI to make smart investment decisions? Or are we just rolling the dice and hoping for the best? It's a valid concern, and one that we'll explore in more depth as we move forward. Moving on, let's talk about some of the common concerns people have about trusting AI in investment decisions. One of the biggest misconceptions is that AI is infallible, that it's somehow above human error. But this isn't the case. AI systems can be flawed, just like any other system created by humans. The difference is that these flaws can be much more subtle, making them harder to detect. For example, if an AI system is trained on biased data, it's going to produce biased results. And if the data is incomplete or inaccurate, the AI system will likely make bad investment decisions. So, it's crucial that investors understand the limitations of AI-driven investment tools and don't put too much faith in their abilities. Another concern people have is that AI-driven investment tools lack the human touch. They are unable to understand the nuances of the market, the subtle shifts in sentiment that can make or break an investment. And to some extent, this is true. AI systems don't have the same emotional intelligence as humans, and they may not be able to detect these subtle shifts. But what AI systems lack in emotional intelligence, they make up for in speed and efficiency. They are able to analyze vast amounts of data in seconds, giving investors a competitive edge in the market. And with the right programming, AI systems can even be designed to mimic human intuition, making them even more effective in the long run. Some people also worry that AI-driven investment tools are a black box, that they are unable to understand how the system arrives at its investment decisions. And this is a valid concern. If an investor doesn't understand how the system works, how can they trust it to make smart investment decisions? But this doesn't have to be the case. With the right transparency and accountability, investors can understand exactly how AI-driven investment tools arrive at their decisions. And with the right regulation, investors can be confident that these systems are working in their best interests. Another concern people have is that AI-driven investment tools will replace human analysts. And to some extent, this is true. AI systems are able to process data much faster and more accurately than humans, making them more efficient in the long run. But this doesn't mean that human analysts are obsolete. Instead, AI-driven investment tools should be seen as a tool to augment human analysis, not replace it. By freeing up human analysts to focus on higher-level tasks, AI systems can actually increase productivity and efficiency in the long run. Some people also worry that AI-driven investment tools are only available to wealthy investors, that they are somehow exclusive to those with deep pockets. And this used to be the case. But with the rise of fintech and robo-advisors, AI-driven investment tools are now more accessible than ever. In fact, many robo-advisors offer AI-driven investment tools for a fraction of the cost of traditional financial advisors. And with the rise of mobile trading apps, investors can now access AI-driven investment tools from the palm of their hand. So, what are the different types of AI investment tools available, and how do they work? One of the most common types is robo-advisors, which use AI to manage investment portfolios. These systems use complex algorithms to analyze market trends and patterns, and then make investment decisions based on that analysis. Another type of AI investment tool is sentiment analysis software, which analyzes social media and news articles to gauge market sentiment. This information can then be used to make more informed investment decisions. Some AI investment tools even use machine learning to improve their performance over time. These systems are able to analyze their own performance, identify areas for improvement, and adjust their strategy accordingly. AI investment tools can also be used for portfolio rebalancing, automatically adjusting the portfolio to maintain the optimal asset allocation. This can be especially useful for investors who are busy or don't want to constantly monitor the market. In addition, AI investment tools can be used for tax optimization, identifying opportunities to minimize tax liabilities and maximize returns. This can be especially useful for investors who are approaching retirement or have complex tax situations. AI investment tools can even be used for risk management, identifying potential risks and opportunities in the market. This can be especially useful for investors who are risk-averse or want to minimize their exposure to market volatility. One of the most promising areas of AI investment tools is in the field of alternative investments. AI systems can be used to identify opportunities in alternative assets such as real estate, private equity, and cryptocurrencies. AI investment tools can also be used to identify opportunities in emerging markets where traditional investment tools may not be effective. This can be especially useful for investors who are looking to diversify their portfolios and gain exposure to new markets. Now, let's take a look at a case study of how AI-driven investment tools significantly outperform traditional methods. In a recent study, an AI-driven investment portfolio was pitted against a traditional portfolio managed by human analysts. The results were astounding. The AI-driven portfolio outperformed the traditional portfolio by over 20%. But what's even more impressive is that the AI-driven portfolio required much less human intervention. The AI system was able to automatically adjust the portfolio in response to changes in the market, minimizing the need for human intervention. This case study highlights the potential of AI-driven investment tools to significantly outperform traditional methods. By automating the investment process and minimizing human error, AI systems can give investors a competitive edge in the market. So, what are the benefits of using AI tools for investment? One of the biggest benefits is speed and efficiency. AI systems can analyze data in seconds, giving investors a competitive edge in the market. Another benefit is accuracy. AI systems can process data much more accurately than humans, minimizing the risk of human error. AI systems can also provide transparency and accountability, giving investors a clear understanding of how their investments are being managed. In addition, AI systems can provide diversification, giving investors access to new markets and asset classes. Finally, AI systems can provide scalability, allowing investors to grow their portfolios quickly and efficiently.